Hey guys, how's it going? Welcome back to a very special edition. This week we'll be talking about taxes. One of two certainties in life, death and taxes, of course. Benjamin Franklin quipped a couple centuries ago, but we're going to talk more about the scope, the nature, what taxes really look like in the world around us. So without further ado, let's dive on in. Um, First, I think we should remember some important points that we have already hit to some point, to some extent, and so far in this class. Whatever we tax, we discourage, right? This is where dead weight loss is created by market distortion, right? When we tax something, we make it more expensive. We tell people, hey, this is something that has additional cost to it, right? So whatever we tax, we discourage. We should remember we can use taxes potentially to address some externalities, our Pigouvian corrective taxes that we talked about, and we may run into the free rider problem as we invest in public goods. So worth keeping these things in mind as we approach our tax system. So this first slide here shows that for recent history, since like the 40s, the US government has accounted for about 25% of all of our economy. So GDP we can think of as simply national income. So each year you make a salary, our country makes a GDP. Fair enough? And roughly right now that is just a smidge above $20 trillion. It's an awful lot of money. This y-axis over here is showing revenue as a percent of GDP. So how much do we spend on the government as a percent of our income? And we can see that in the early 1900s, it was very, very small percentages, right? Less than 10%. And interesting enough, federal spending in the very earliest part of this period was actually less than state and local spending and receipts. Isn't that interesting? So really around World War II, we enter this modern era of spending roughly a quarter of our income on taxes on government, right? This is much more than we did 100 years ago, but no surprise, right? Our government does an awful lot more than it did 100 years ago. Rolling right along here, we'll see that this 25% that we spend is actually quite a bit less than some of our peers in the world. So we see a handful of developed West European countries here. So Denmark, France, Sweden, Italy, Germany. All of these countries spend a lot more of their income, their GDP, on the government as a percent, right? As a percent. So even, Denmark here spends roughly half of their yearly income on the government. And generally, this is true. Other developed countries spend more on their government than we do. Where does this money come from? Our federal government's tax receipts? Well, a whole bunch of it coming from income taxes. 43% of all the money that the government takes in comes from personal income taxes. And another 35% comes from social insurance taxes. You guys may remember that this is our old friend FICA, right? This is our payroll taxes, half coming from you, half coming from your employer, right? This adds up to 35% of all tax receipts. Taken together, we see that income and payroll taxes account for the vast majority of revenues that the federal government brings in, right? The vast majority of revenues come from these income and payroll taxes. Also worth mentioning, these are corporate taxes here. They make up 13% of government revenues, federal government revenues, and this is money taxed on companies' profits. money taxed on companies' profits. Last but not least, this other category here is going to be all other kinds of taxes. So excise taxes, tariffs, all these other taxes are going to make up this remaining 9%. Well, I figure it's worth taking a couple seconds here to go through how an income tax works, because I don't think that this is something everybody is super duper familiar with, so I figure I'll hit this real quick. So how does an income tax work? Well, first things first, we calculate total household income, right? So we add up all the money you make. So money you make at your job, wages and salaries, money, a lot of families own their own small businesses, so any profits you get from your small business. When there's no pandemic going on, I run a small business. I like to host bar trivia. This is kind of my side hustle. So my profits from that would be included in my household income. We'll include dividends from stocks and returns on savings as well. A bunch of other stuff count as household income. But once we add up all our household income, we're not finished quite yet. We also have to subtract out deductions, right? We have to take out deductions. We start by multiplying number of dependents times the dependents deduction, which I believe is $2,000. So essentially the idea there is you get a set amount off of your taxes for each kid you have. And then we'll also need to take out deductible expenses, which might include like mortgage payments, charitable givings, certain business expenses. This is the kind of thing that you can quote unquote write off on your taxes. I'm sure you guys have heard this phrase before. And always, if it benefits you more, you can always just take the quote unquote standard deduction if you don't want to add up your dependents and your deductible expenses. And once you deduct out these deductions, you take that out, you subtract those out. Now we have our adjusted gross income, and now we can apply our tax rates. Now this is very important, and a lot of people get confused here, so follow me closely. Here we're looking at our tax brackets. This one up top comes from our book. It is a little older if you guys were curious about our actual current tax brackets. I got them right here. These are different because of the 2017 tax cuts by the Trump administration. So I do want to go through and how this works. So let's focus up top here for a second. These tax rates are marginal tax rates. Marginal. Marginal is a very important word to economists. All it means is as we add a little bit more. In this case, as we add a little bit more money. So this being a marginal tax rate means that for the first $9,000 you make, you pay 10% on it. Then for money you earn from $9,000 to $36,000, you pay 15% on it, right? Money you earn from $36,900 to $89,000, you pay a quarter on, 25%, and so on and so forth. I want to be very clear here. Just because you make $500,000 a year, which is in this bottom tax bracket here, doesn't mean you pay 39.6% on every single dollar, right? You only pay this money, this top tax rate, on the money above this $406,000 figure. These are marginal tax rates as we add a little more money. Very important to understand this, okay? I think this is something a lot of people don't get. So these tax rates are marginal, and we'll revisit this term marginal quite a bit throughout the rest of the semester. Also, go ahead and note here, we have what is called a progressive tax system, which means as incomes increase, the percent tax rate also increases, right? So as we move down this table, increasing incomes over here, we're also going to increase our percent paid in taxes. Again, this is on the dollars above these different thresholds. All right. Where do the states get their money? Well, states rely mostly on sales taxes and property taxes, right? Sales taxes accounting for roughly a quarter, of state tax revenue, property taxes accounting for roughly a fifth of state tax revenue. So a sales tax is just usually a percent tax you pay on all of your goods that you buy. Yeah, so states are going to rely on the sales tax. There are different pros and cons to this. Maybe a sales tax discourages purchases but encourages savings. Maybe there's some nuance and difficulty here, but we can see that our states rely much more on sales and property taxes than income taxes, like the federal government does. Interesting enough, the federal government actually gives the states money as well. This is about a fifth of all the money that the states bring in comes directly from the federal government. So this is just another way of states making money. They take grants from the government, block grants and other grants, in order to pay for different projects. And the federal government gives states all sorts of different money for different projects. And this other category down here is going to include your excise taxes, your externality taxes, and your kind of lotteries and stuff like that, the rest of that money down there. Rolling right along here. There are a couple different goals we might consider as we decide what we're going to tax or at what rate we're going to tax it. Our first goal is going to be having efficient taxes, taxes that minimize the cost of creating this tax revenue. The two costs that are relevant are deadweight loss and administrative burden. Deadweight loss, of course, is the loss of surplus, producer and consumer surplus, that occurs because we've distorted the market, right? Because we've told people the price of this is higher than it is, so less people are going to buy it, right? This is where deadweight loss comes in. Administrative burden comes in as we pay people within the government, specifically the IRS, to figure out what different people owe on what taxes and to take that money in. And we also spend our administrative burden in the private sector on accountants and tax pros and lawyers, H&R Block people, TurboTax software. We spend a lot of money and time figuring out how much we owe in taxes and getting it paid. This is really big business, right? For businesses and individuals, figuring out how much taxes we owe is a big part of our lives. So there is an administrative burden to taxes, right? And it's worth mentioning that if we wanted to create a tax that charged as little cost outside of the dollar value of the tax, we might be interested in something called lump sum taxation. Lump sum taxes. And all a lump sum tax is a tax that charges everyone in the country the exact same amount. Everyone in the country the exact same amount. In regards to deadweight loss, well, deadweight loss happens as we discourage a behavior, right? Well, if we lump sum tax and we tax everyone the exact same amount regardless of their behaviors, it doesn't matter what you buy, it doesn't matter how much you make, everyone owes the same thing, there isn't any deadweight loss created because there's no market distortion. And when it comes to administrative burden, I think the IRS and your tax pros would have a much easier job figuring out how much you owe if everyone in the country owed the exact same thing, regardless of how many kids or what deductible expenses they spend their money on or how much money they make. Now, this is not a real tax that exists. This is kind of up in the heads of our economists, right? And the reason it doesn't exist is because efficiency is not the only goal of our taxation. Some of you are probably already thinking, man, a lump sum tax sounds pretty unfair, charging everyone the exact same thing. There's a lot of poor people and there's a lot of rich people, right? And this brings us to our second question, our second goal of taxation: tax equity. How fair can we make our taxes? How fair are our taxes? And as we weigh this, we might want to keep two ideas in mind. First, the benefits principle. And the benefits principle argues that those who benefit the most from the government should pay the most in taxes. And really the direction that this takes depends on what you see as a quote-unquote benefit. So if you choose to only view a benefit from the government as dollar transactions, benefits in the form of like Social Security and Medicare and welfare, stuff like this, if you choose to take that scope, then you may be left with a result from this benefits principle that the poor should pay more in taxes, right? But if you take a more kind of zoomed out view, maybe a more open-minded perspective on this, and see a benefit as not just dollar amounts, but more broadly, there may be some other benefits to it, then we may see that rich people could probably stand to pay a good portion of the taxes as well. Because after all, somebody who becomes wealthy in this country has certainly relied on our safe borders, right? On having a national defense, right? On having public roads and transportation and a good, strong workforce to rely on, educated workers to rely on. People who make it in this country benefit greatly from the existence of police, right? As they protect their investments, protect their property, right? And they benefit greatly from the existence of fire services and EMS services, especially fire, considering, if you got a big house, it's worth a lot more for you to spend a little more protecting it from that sort of thing. So the benefits principle is kind of in the eye of the beholder, right? A lot of these taxation issues are, right? The ability to pay principle argues that taxes should be paid by those who can afford to pay them. Taxes should be paid by those who can afford to pay them. And maybe that's a pretty fair thing to ask. But we may have two different questions within this idea of the ability to pay principle. We may have two different concepts of equity. So these two different kinds of equity that we might weigh are vertical equity and horizontal equity. Vertical equity refers to the idea that those with more money should pay more taxes, and horizontal equity refers to the idea that those in similar situations should pay about the same amount in taxes. So first to this idea of vertical equity. Well, this is clearly along the lines of the ability to pay principle, right? Those with more should pay more. But there's this question here. What does that mean? Let's look at a couple different ways of taxing people and see if we might come to different solutions here. So here are three different tax systems: proportional tax, regressive tax, and progressive tax. In a proportional tax, no matter how much you make in income, everybody pays the same percent, right? This is also called a flat tax. Under a regressive tax, the more you make in income, the less you pay in taxes. And under a progressive tax, the more you make in income, the more you pay as a percent of that income, right? Well, interestingly enough, as you look at all of these taxes, you notice that for these individuals, one with 50,000 income, 100,000, and 200,000 income, in each situation, the person making more money is paying more in taxes, right? The more money you make, the more you pay in taxes. Now, I want to be clear here. Only in the progressive sense, the progressive tax, are they paying more as a percent of their income. But in each example, they're paying more in dollar value, right? In this amount of tax section, they're paying more. So, what is vertical equity? Where are the wealthy paying the right kind of balance of this? I don't know. You guys will have to think about it and get back to me when you figure it out, right? But it may be worth taking a quick peek at where we are now. These are quintiles of earnings. Quintile meaning 20% groups. So 1/5, 2nd fifth, 3rd fifth, based on how much you earn. So the lowest quintile, the lowest fifth of earners in this country have an average income of $24,000. They spend 2% on average of that $24,000 on taxes. They receive 5% of all the income that's made in this country, and they pay roughly 0.5% of all the taxes. And we can contrast that with the highest quintile and see that those in the highest quintile pay $245,000 or receive $245,000 in income on average. They pay on average 23% of that in taxes. The top fifth of earners make more than half of the money in our economy. This is pretty important, so I'm going to circle it a few times clumsily. The top fifth of earners make roughly half of all the money in our economy. And critical here as well, they pay roughly 70% of the taxes. They make half the money and pay 70% of the taxes. Again, this is just the top fifth of earners. And we can look at this another way and find that the bottom 60%, these three groups here, bottom 3/5 pay roughly 15% of the taxes. So the bottom 60% of earners paying roughly 15% of the taxes. So this is where we're at now. This middle column shows us without a doubt, as your income increases, your tax rate increases in our country. So we definitely have a progressive tax system, right? And we can debate whether or not there's vertical equity here, but it's kind of tricky. I wanted to revisit horizontal equity one more time to say, so those in similar situations should pay the same, right? This may seem super straightforward, but it's not, right? Those in similar situations should pay the same. Well, we can imagine two different families, right? We can imagine the Smiths and the Joneses. And the Smiths, they make $100K, they have 3 kids, and all their kids are in college. So they pay a ton of money in tuition every year. The Joneses, they make $100K, they don't have kids. Maybe they're in a different situation. But Mr. Jones perhaps spends a whole lot of money on medical expenses, right? This is a complicated thing. What do we tax? What counts as a deductible expense? Do we allow the Smiths to deduct their tuition expenses? Do we allow the Joneses to deduct their medical expenses? This is nuanced stuff. Just because somebody makes the same amount of money doesn't mean they're necessarily in the exact same situation, right? So deciding what is horizontal equity may be difficult, right? It may be difficult. So I hope you guys have found this discussion of taxation and tax systems interesting. Really think about it, read through chapter 12 of ManQ, and really consider these value-laden, difficult topics. And I'll see you all next week. Thank you so much.